Hi, welcome to the Voice of Creativity podcast. I'm your host, Brennan. Today, I get to share with you guys one of my own personal marketing Yodas, Allan here. As a marketer, as an entrepreneur, and now as an investor, Allan has spent his entire career focusing on bringing innovation to life. He's got a really measured, structured, unique way of thinking about creativity that I think you're all going to love. Without further ado, here's Allan. Allan, welcome to the podcast.
Thanks, Brennan. I'm stoked to be here.
So, marketer, founder of several things, and most recently RevUp Capital, which we're going to get into in a second.
Okay.
Carnegie Mellon alum,
True.
early advocate of crowdfunding, I think, right?
Yes.
And then most importantly to me, marketing growth startup Yoda, wise gentleman that lends his time for people like me running startups. So that is the most concise kind of like intro I could give. Obviously, won't be able to capture all of your wisdom and distill it perfectly in this one episode, but I think we're going to give it our best shot. So before we dive into some of the more recent projects and things you're working on, I think it would help everybody to just get a quick background. After college, how did you get started in this world? Do you mind starting there?
Sure. Yeah. So, obviously I run with my partner, Melissa, run RevUp Capital now. We are a revenue-based investor in early-stage growth companies. So we invest into companies based on their revenue growth, and we make our money back based on revenue. So it allows us to invest into a wider variety of situations without being overly focused on exits for the company. But I got there through a circuitous path, as probably most investors do. I actually started out as a technologist when I graduated from college. And so I was an engineer at a big company for almost 10 years. And I was lucky enough to go around the world with them. So I went from North Carolina to England to India, and then back to Atlanta. When I got back to Atlanta, I got bitten by the startup bug in Internet 1.0. Just tell how old I am. And did a spin out of that big company. So that's what got me started on my startup journey. Still pretty technology focused, but that started to shift me more into marketing roles, first in product marketing. And then from that startup, which ended up going public, but the group of peers that I was with didn't have a very large ownership stake in the whole thing. So we left and started another company, which was venture funded. We built Pandora about 4 years before Pandora built Pandora, which teaches you that timing is everything.
Which is before Spotify, but Spotify too.
Yes, you have not heard of Encanta, but you have heard of Pandora. Although I don't wish for their long and circuitous journey either. But we built one of the first early streaming media companies, and that really focused me in then on the importance of marketing, either creating a brand directly to consumers, figuring out how you were going to get customers, and then creating relationships on the B2B side that where there was a recognition, a mutual kind of value interchange. So that really occasioned my shift from being an engineer, being a technologist, into being a marketer. I started a few other companies after that. We had the whole .com bust. So I started a bootstrap company after that, and that was pretty successful. And then I became a dad. It took me into the world of suddenly wanting to focus on something else. So I became a consultant for a while to gain the freedom, and that moved me into innovation, which was super interesting. So I did innovation work for about 5 years with large corporations and economic development organizations. Which ultimately led me back to startups, partially because when you do consulting, you get tired of giving people the right answer and then them not following through. And partially because you when you start doing innovation work, you really realize the importance of startups in the innovation cycle and how difficult it is for large organizations and governments and economic development organizations to create innovation without that energizing role of startups. So that led me back eventually to the startup world. I started in one of the first early startup accelerators in 2009 with some partners. We funded about 90 companies through that model, which then led me to ultimately to RevUp in 2015.
So one of the first streaming media companies, one of the first startup accelerators. Maybe you need to have a good idea and then sit on it for 5 or 10 years.
Number one lesson is timing is everything, and most often you get it wrong. Yeah.
That's funny. Yeah, I feel that way moderately to a degree, but I don't think I can brag about that as hard as you can. That's awesome. But that's good. So yeah, and so you've seen I appreciate you kind of taking us all the way through, because I think that's really important when understanding. Obviously we usually just like pigeonhole people. We met them as the marketing guy or whatever, and we kind of think of them as like one-dimensional. But I think most people have that kind of background where it goes all over, and they kind of bring pieces of that each little experience to their current experience. Yeah. And I think that might be why you have such cool advice for us all the time. I was taken that you said, the reason you didn't like consulting is you give advice and no one takes it. And I was going to ask you, do you think startups take your advice better? I would imagine it's similar that, we hear it and we recognize it for wisdom, but perhaps we don't take it as often as we should.
Yeah, that's an interesting question. I definitely prefer advising startups to advising large organizations. I would say that the reason why large organizations don't take good advice is because there's something within the inertia of the system that prevents them from it. So there are individuals in the system who realize that that the answer is probably objectively and subjectively right, but the system prevents change from happening. Whereas when you're advising startups and they don't change or they don't take advice, it's because they're in a very dynamic environment. It's hard for founders individually to change. And there's and they're getting a lot of competing advice. So the question of what is objectively right kind of reveals itself maybe only over time. So I take it less personally. Now when a startup doesn't take my advice or comes around to it circuitously in a long way. Definitely my giving advice portion of my career as applied to startups has been a lot longer than my giving advice to large organizations.
That's awesome. Yeah, as a founder, I can confirm that my biggest challenge, besides any personal issues I may have at taking advice or being stubborn or something, is for every piece of advice I get one on the opposite side. And so it's that is a hard, that if you can solve that, that's the next startup that was going to be huge is, how do you run like a product feedback process for advice for your own company? I don't know. That's cool. But so that's awesome. So before we dive into RevUp and get kind of up to date on what that's doing and more about that, I had read and I'd been vaguely aware years ago that you were involved with kind of advocating for equity crowdfunding. And since that's having a moment right now, I figured we just touch on that before we go in. So what was your involvement in that? And what was your take on equity crowdfunding?
So it's kind of back to this early adopter thing, right? When the Jobs Act, was in the legislative cycle, there was a lot of advocacy going on around it amongst the startup community leadership at the time, and it was something that, for example, Naval from AngelList was pretty involved in advocating for its passage, and I think I may have gotten involved or become aware through the advocacy work that was around there. I don't quite remember because it was like 2010, I think, when they started cooking it up. But I just realized the opportunity to democratize funding. I mean, anytime you're talking about how do we make more startups, which is ultimately the question that I'm interested in. How do we make more startups? How do we make founders more successful in those startups? And how do we make those startups more successful in the world, right? So if you believe that that economic dynamism and startups as a vehicle for new ideas are a force for good. And if we applied them more consistently, both across the U.S. And around the world, that more good things would happen. Then you arrive logically to the question of, okay, well, how do we democratize the things that you need to do to create successful founders and successful startups? And obviously, how startups get funded in their earliest days and how you allow or enable them to raise money is a big part of that, right? And a lot of the other parts of how we democratize startups have happened, right? Knowledge has been democratized in an incredible way. I think that's probably the most successful example. The networks have become democratized. There's still a lot of concentration, right? Geographic concentration and privilege concentration, but 10 times is, 100 times the access that there was when I started my first startups. But I think capital, is still something that we're hammering on. And I saw equity crowdfunding as being an effort, an imperfect one, but an effort to start to crack that nut. So that's what got me interested in it. And because I live in Rhode Island, which is, which has the privilege, despite being a historical anachronism and, a place stuck between Connecticut and Massachusetts, we nevertheless have two senators of our own. And that gave me perhaps an outsized opportunity to lobby for the passage of the Jobs Act, along with people who were in much larger states who also only had two senators. So as a result, I got to go to the White House and be in the Rose Garden for the signing. It was pretty cool.
That's huge.
Yeah.
Which president was this? Was this under
Obama?
Obama?
Yeah.
I don't remember what year that was.
I was. It was only the only White House event that I've been to. So, and I was definitely not blasé about it. And I had a friend who arranged for me to sit, who ended up getting me a seat in the front row. And so I was in the front row, and President Obama came out and he was doing his thing. And as he was leaving, he turned and we've all seen his wave, right? The wave that he does on the way back into the West Wing. He turned and waved, and I thought he was looking at me, and I went like that. Looked at me like, dude, I wasn't waving specifically at you. I was just generally giving the wave.
People have those moments that they relive and cringe and stuff. You have a presidential one that's awesome.
If there had been a camera on me, it would have been a meme. Yeah.
Like, not talking to me. That's awesome. That's so funny. And so when you think about startups like that, it's almost is it? I guess I'll ask as a question: is it a proxy for like innovation in general? Because it sounds like what you're saying, and I don't want to put words in your mouth. I just want to understand better. It sounds like when you're saying like, yeah, we want to start more startups, fund them better, help them succeed better, right? It sounds like the fundamental reason for that is like how you inject innovation into the system as currently designed. Is that right?
I think it is an important way.
Yeah, maybe not the only way, certainly.
and I think that innovation is an overused word. I probably overuse it. It definitely, has become a word like Kleenex, right? So it applies to everything, right? Everything paper. I really, if I were to dig deeper, I think about it more as economic dynamism. Like, how do we surface new ideas more quickly? How do we give vehicles for people to create success at whatever scale it is that they're interested in creating, and either for themselves or for their communities? And I've become quite interested more in, entrepreneurship as a vehicle to help people realize the dreams that they want to achieve and the impacts that they want to have, and less so about the big I innovation, SpaceX, Virgin Galactic, Moderna. That stuff's super important, and we need startups that do that thing. right? But if our understanding of what a startup is converges only on the top of the pyramid, then we neglect the idea that really, this desire amongst humans to build their own thing and to have an impact on the world and create something for themselves, that's at the core of what entrepreneurship is. And we, if you really look at the trends around entrepreneurship, at least in the US, what you see is we have, had a 20-year-long secular decline in new business startups. And
of all types?
Yeah, of all types.
Like when you just look at like fresh starts of businesses.
Yes, it's business formations minus business deaths, right? And so that index has been declining for 20 years, despite our last 10 to 15 years of startup mythology, right? Which is really about the things that are at the top of that pyramid. And you can't have a pyramid without a base, right?
Yeah.
It's a different kind of structure and it's wobbly. Right. Without going really deep into kind of social constructs and questions of inequality and who has access and all this kind of stuff, I think you can broadly say that, your startup pyramid, if you want to have a healthy top, has to have a healthy bottom. And so that's what I've become more interested in. And that's where the Revit model really grew out of my belief that we need more entrepreneurial access in more places for more people, and they can be more successful overall.
Awesome. I love that. And I like economic dynamism is more specific and broader, I think. I like that. And so one question would be, when you say the tip of the pyramid, someone could mean, like in success or something. Someone could also mean like in terms of actual innovation versus, inventing new things, pushing the envelope technologically versus, building a pizza chain that like brings a lot of happiness and wealth to people, like does things that the regular economy wants. Right. Well, is that like, what do you mean by when you're kind of thinking about like the tip of the pyramid and like not just fetishizing and focusing on those? Do you mean like effectively not just focusing on innovation and invention and things kind of pushing the technological envelope, or do you mean it more of like from a size and renown?
Yeah, I'd say there's multiple sides to the pyramid, right? Like there's definitely are you doing something hard or not, right? There's definitely the how large is it, and there's definitely the thing that we in the startup community has always had a problem with focusing a lot on how much money have you raised, right? Which is an external signal that's presumed to be a precursor of success. And all of those, I think you can progress on one or all of those things, and there's some assumption that they go hand in hand, but not completely, right? There's lots of people who do hard things that where you've never heard of the company, right? And it doesn't necessarily become huge, but it plays an important role. There's lots of people who raise a lot of money and then fail, right? They fail to meet their objectives or fail to have the impact that they intended. So I don't think they're strictly correlated, but they're kind of, when I talk about the top of the pyramid, I'm speaking generalized around companies you've heard of, companies that get big, companies that raise a lot of money, companies that make a lot of money, companies that do something hard successfully, right? We need all these things, right? But you don't have to be starting a space tourism company in order to be important, to be an important startup, right? Even if you're just important in Boise, right?
That's true. That's something you guys do, and to get more into RevUp, you guys seem to be, and I don't want to put words in your mouth, but it seems as an outsider's perspective that you guys really do actively focus on geographical diversity as well as you said, kind of other parts of the pyramid. Is that something you guys are actively trying to do? And if so, like, how do you think about that? Is it like trying to balance out, just the fact that we've kind of like we have these centers of influence all over, and maybe you can level the playing field, or is it that there's better deals and cooler things to find where everyone else isn't fishing, or but maybe both?
It's a little bit of both, right? So some of it, if you think about the U.S. venture capital landscape, we've basically been stuck at 80% of funding happens in the top 5 metros, and that's been true since it began, right? And so we're moving down slightly. It might have gone down from 80 to 75, but the amount of money that's going into venture capital has also now exceeded Internet 1.0 levels. So you can't have a tail without a head, right? So even if we've gone from 80% to 75% geographic concentration, you're also talking about many more billions of dollars flowing into the system overall, which means that proportionally, LA, San Francisco, Boston, New York, are still getting the vast majority of the money. So there's part of it as entrepreneurial investors, part of it is going where there's less noise, right? So there's definitely less noise in Raleigh or Pittsburgh or Nashville than there is in New York or Boston, right? Not that we haven't done great deals in Boston, including yours, right? That's our home market. I think it's our home market, and by city that has the most, we still have the most RevUp investments and RevUp alums in Boston.
Nice.
So we don't have any problem finding good revenue-driven companies in those cities. It's just that we recognize that there is talent and opportunity. If you're focusing on companies that use revenue as a primary driver of growth, which is what we focus on, then a lot of times there's a necessity to do that when you're in a second and third tier metro, because you don't have as much equity investor money available to you to forestall that decision about driving revenue. You've got to get there earlier, and you may need to, you may not raise as much as you might raise in a larger metro. So you've got to use revenue to balance that out in order to grow. But I think there's partially it's in the DNA of second and third tier metros. It's also definitely us avoiding the noise of big venture capital funding that tends to happen in the top 5 cities.
Has COVID, maybe there's no stats on this yet, but has COVID dramatically changed the concentration? It seems like if, my last round was all Zoom. I didn't meet anybody in person. So there are investors from Boston, but there are investors from all over as well. So it seems like the inverse would also be true, perhaps, that if my counterpart in Nashville is raising, maybe the idea that they can't, shake hands and grab beers and go on a boat or a roof deck with somebody is not a deal killer anymore. Have you seen any of that?
I have. I think that the definitely the funding environment generally is hot right now, and so there is a lot of money that's flowing outwards. It's our understanding of it is a little biased because when you look at the overall volume of money, there's not a recognition of the role that mega rounds play in that. So if you take mega rounds out, you find that it's not as much increase in funding and in deal flow as you would have expected. And if you talk to underrepresented founders, then you will find that it hasn't become massively easier suddenly for them to raise money either. So I don't think I've seen so much of a shift in the funding environment because of COVID crossed with geography. We definitely in our deal flow have seen more and more companies that I would just specify as headquarters the internet, where we don't even think about them as being in a place, right? Like we just made an investment in a company where one of the founders happens to be here in Providence, and one of the founders was in Medellin when we invested in him, and was in Togo when we were doing his onboarding, and is in Croatia now, right? And it doesn't matter, right? And that's
right, irrelevant.
I think that it is possible to start a revenue-driven company in that mode, just as it's possible to start, lots of companies in that mode, and we'll invest in them.
So awesome! So that was a great backstory, and you've already kind of touched on this a little bit, but um, what are you looking for? If there's a potential future founder that you want to invest in listening, what exactly, we've touched on a few, right? Like different parts of the pyramid, perhaps from somewhere else or nowhere, theoretically. We've touched on a few things, revenue driven. What though, if does that break down by, are there specific industries that get you guys excited? Are there specific business models that you're looking for? Or is there anything else that you guys are kind of like keying in on quickly to say, oh, this deserves our extra look?
So it might help if I give a little background on the emergence of revenue-based funding, revenue-based investing,
Totally.
because most people still haven't had much exposure to it. So revenue-based investing, almost the same way that venture emerged from this, it was done as a handcrafted, all the deals looked different for quite some time. And then it had a series of coalescences that turned it into an industry with common practices and common tools and common set of information. Revenue deals or equity alternative deals have been that same way. So they've been in existence out in the market for 20 or 30 years, used in other industries, moved into technology, were all handcrafted on the side. No one really knew the firms that did them. And in the last 5 to 7 years, it has emerged as an asset class. So it's kind of become organized. Funds have declared themselves as being revenue-based investing firms. The amount of assets under management has increased dramatically. And now, revenue-based investing is recognized and now accepted as a way to invest into companies that have a proven revenue model in order to help them grow. And revenue-based investing has, two characteristics to it, right? One is that you need to have a business model that works early on, right? That is probably unit economic profitable, even if the overall company is not profitable. And the business model needs to be robust enough such that you're comfortable paying a small percentage of revenue over time until some requirements are met, whether that's a fixed multiple, whether it's a time window, right? The deals are structured a little bit differently. But you have to be comfortable that your business model can support that. And the other thing that both the investor and the founder need to be confident of is that the business is going to grow. All right. Now, revenue-based investing can take all sorts of growth models into account, so slow growth all the way up to hypergrowth, whereas equity tends to focus on things that are at mid to high growth, especially in the early stage. Right. You need to be able to show fairly aggressive growth in order for the calculus to make sense for an equity investor. So revenue-based investors can invest into a wider group of companies with a wider group, set of growth parameters, but it can't be a company still in search of a profitable business or revenue model. That's a pretty big differentiator. And then there's really two big pools of money in revenue-based investing. One is 12 months or less, and one is 12 months or more. It's basically the way to think about it. So there's the largest volume of revenue-based investing right now are companies like Pipe.com and Clearbank, who are putting hundreds of millions of dollars really into 12 months or less instruments, with the idea that you may have e-commerce sales where you buy inventory on day 0, you do digital advertising on day 30, and by day 90, you have all your money back plus your profit, right? Which then enables you very comfortably to sign a 90 or 180-day rotating kind of cash agreement to keep that cash moving and allow yourself to grow very flexibly. That's very different than what we do, which is we're investing in the companies for long-term capacity to take some chances and run some experiments with the overall belief that over a 3 to 5 year period, the company will do well. We'll basically, we look for companies that can 10x in that 5 year time period. And so our horizon's much different. It's a little bit more like equity. We're investing over a longer time period in terms of how we expect a company to spend the money and the way in which they would see the money come back. And a lot of people confuse the two, like they need a less than 12-month solution, but they come and they talk to a greater than 12-month player. And it's important to know that both of these things are growing simultaneously. There's a lot of tools in the less than 12-month category. There are a lot of tools in the 12-month or greater category, but they really, other than using revenue as the common denominator, they actually behave very differently.
Got it. Okay. That's cool. That I was completely unaware of that, actually. The kind of two major classes. To me, it seemed just kind of like, if you'd asked me, I would have assumed there was some sort of spectrum. But if it kind of breaks into two different...
break in the middle, right? So because you'll think about cost of capital very differently. You'll think about your capital turn time, both as an investor and as a founder, very differently. And you'll think about the amount of faith that you'll want to have that the money's going to come back very differently, right? Like in your case, for your kind of company where you're building an enterprise sales organization, right? If you would use our money to go hire a VP of sales or a sales director, where you're taking a chance to invest on them. They're supposed to build an organization for you, and you're going to see the fruits of that over definitely greater than 1 year time frame, right? Probably a 3 year time frame if it works, and it might not work, and then you have to go do it again, right? Whereas if you're making a decision to add another salesperson to a model that is already working, right, and that salesperson is going to yield. Generally, they're going to know whether they work out in 90 days and they're going to be paying for themselves in 180 days, then you can be reasonably sure that you could take less than 12-month money in order to do that, right?
Totally.
Because you're going to take the money from a less than 12-month investor. You're going to go hire a salesperson. You're going to onboard them. They're going to start to pay for themselves. And then you still have kind of 6 months of, either do it again money or, money to basically like smooth that out.
That's awesome. And so are there some, I don't know what the kind of like privacy rules are, but are there some stories you can share so that somebody listening could hear, like this kind of company came to us in this stage and we put we kind of what we saw and how we looked at it, and then a few years later, this is what's happening. I don't know if you're allowed to kind of go into that much detail publicly about these things.
Yeah, I can probably see if I can abstract, some of them for you. So,
that works.
We invested into, we tend to invest into 3 categories: niche SaaS, e-commerce, and technology-enabled services. Okay, so those are the 3 categories that do well for us because you generally need a working revenue model for all of them in order to even get from 0 to 1, right? And we tend to invest in companies at about, definitely have to be north of $500,000 of revenue. Our average was about $1 million, although we're going a little earlier. So I think we're coming back from $1 million to more like 750, 800 now in terms of an average of when we invest into a company. So you have to have shown that some stuff's working, right? In order for us to analyze whether we think you can do more of it or not. So a good example for us is we invested into an enterprise software company that does identity verification for non-U.S. markets. And that's, with the explosion of the sharing economy, so things like Uber and Lyft appearing in other countries and needing to onboard drivers, for example, or being an Airbnb host in another country and needing to verify that you are who you are and that you own the place that you own, but you don't have the necessarily the same identity verification patterns in the U.S. in those other countries that we have here in the U.S. Right. So this company specialized in that. There was a couple of identity verification experts who had done this previously, and now we're creating something at scale. They made money on a transaction basis. So rather than being SaaS, the more volume that came through, the more, they got paid on a per identity verification basis. So that's something that doesn't look like SaaS to a lot of investors, but for us, we could see the repeatability. And when we invest into a company, we invest not just cash, but also capacity. We work with the company on their marketing capacity and on really focusing their marketing in and matching it with their audience. So we worked with them to really build out all of the application examples of the way in which you would use identity verification for each of these countries. And all of those became a lane and a funnel for possible search conversion and content conversion. Imagine a big matrix of all the countries and all the ways, all the things you might use identity verification for. And then you end up with a lot of landing pages, right?
Seems very complex, yeah.
Yes. So, but it's manageable, right? It's a math problem. So we worked with them to build all of that out, test it, run people through it, figure out what people were looking for. And that was a big part of our contribution in addition to our cash with them. But as a result, back to this timing thing, right? Being at the intersection of sharing economy, crypto obviously, requires a good deal of identity verification, and in building out this marketing infrastructure just resulted in explosive growth for them. I think probably 20x over a 2-year period. So
that's huge.
Yeah. So they just really took off. And obviously taking off like that is good for us as revenue investors.
Your incentives are aligned, it seems like.
Yes.
Whereas often that's surprisingly not the case with other equity investors.
True. Yeah. But I'll give you an alternate example though. We invested into a company that does e-commerce services. So they have a physical warehouse. They do e-commerce websites like Shopify integration work. They do production, fulfillment, like all the things that you need but you don't want to do yourself if you're an e-commerce company. And with if you're familiar with the explosion of Shopify and the number of sellers who are on Shopify, then you can imagine that whole world is growing quite quickly. And if you get big enough, you don't want to do the work yourself. You want to give it to someone else to do. Right. That's again an example of a company where it's not venture scale. It involves moving real things around, which a lot of venture investors don't like. But they're a great company, like run by two really competent founders. They were self-taught. They built this thing up based on what customers asked them for. And they grow consistently like 30 to 50% every year, right? It's going to take longer to yield for us because it's not an explosive growth story. It's a linear growth story, but it's growing. And a revenue contract is flexible enough to accept both the explosive growth story and the linear growth story and still see them both as a success. And also what we care about ultimately is that those founders are successful, right? That they end up in the place where they want to be with their companies.
Yeah, your model doesn't break if someone doesn't grow at the world's most exciting pace, which is how traditional investors, VC investors, tend to work, right?
Yeah. And because we don't require an exit, we're not trying to engineer the company towards some event which may or may not happen. That's just. I was very glad to take myself out of the exit game, which was when I was an equity investor. That was the only thing you care about, right? And they're important, but you'd be surprised how few times exits happen.
Yeah. And you're just like, it seems like you should be building the company to be profitable. And I understand that, like for a lot of tech companies with, the way to do that is to be unprofitable for many years and keep borrowing more money or getting more investment. But ultimately, yeah, it seems like you want to get to something where the thing is running and throwing off cash, and that should be good for everyone. And it's kind of odd that the prevailing way we do this is that could make the early investors unhappy that you've built a big business throwing off a lot of cash, which is because they're so exit focused, as you pointed out. That's cool. So I guess to kind of ask the final couple questions, having seen all these different types of companies and all these different types of geographies, different types of people, are there any like macro trends in kind of just broader innovation, technology, things that you're seeing, business models even that you are really excited about, or that you think are kind of like worth other people becoming aware of?
Well, I think we can see. I continue to remain really excited about the globalization of entrepreneurship. I think in the U.S. There's such a focus on what's going on here, and the incredible successes that have been created in the capital markets here, and the majority of the capital markets, are also centered. The majority of the kind of innovation venture capital, capital markets, are centered here as well. But I think that the most interesting things are going to happen somewhere else. Now, people have been saying this for a while, and we've had some. We're in a period of global, global unrest, right? They say these things go through 50-year cycles, and we're going through this really dynamic cycle right now, which is both interrupting practically the kind of entrepreneurial activity in non-U.S. markets, and also interrupting our perception of them, right? Like you have something that happens in like this thing in Afghanistan, right? And you're like, the world is screwed. Let's focus here, right? But it doesn't mean that there aren't really interesting things happening in Brazil, right? Or in Russia, or in East Africa. It just means that they're harder to see through to, and I think that will continue. And if you look at our demographic trends, everything says if you're both interested in building a business and you're interested in investing in businesses, you need to widen your scope, beyond the U.S. So that still remains very interesting to me.
That's a really cool thing to keep in mind. I actually just saw a visualization today, which will be very hard to describe given the nature of visualizations. But it was one of those rare things that actually kind of blows your mind. It was the world map in 2000, so many years ago, colored blue by countries that majority traded with the United States, and colored red with countries that majority their business was done with China. And it was, almost an entirely blue map 2000, excuse me. And then the map last year, 2020. I think as an American, it's hard to understand, but basically it was, Canada, Mexico, most of Latin America, and that was it. Like all of Europe, almost all of Africa, almost all of South America was doing the majority of their exports, imports business in general with China, right? And you say, for your point, like even the way you were phrasing it, it's like the capital markets and startups and culture, a lot of it is here, a lot of the stuff we see. So I don't think we recognize how big the change is here very easily, because it's like maybe it's incredibly obvious to someone in Europe that like they've switched over in the past 20 years to doing more business towards the east, right? But it's like I would not have ever guessed that it was that dramatic in the past 10, 15 years.
Yeah.
And that's an
That's a good
example.
example, I think, of how like the large changes happen after you stop paying attention, right? If you think about when we were really focused on China as an economic actor, right? It was really in the like 2005 to 2014, like that span. And obviously we had our Great Recession in the middle of that with the housing bubble. And then humans just can't concentrate on something for very long before something new comes along to distract you and make you think that that's the most important thing. But it probably was the time after we started paying attention that China kept making progress and kept making the economic moves there that have cemented their their trading position in those countries. And that's the world inexorably marches on even when we stop paying attention, right? I think this is going to be true of crypto as well, which is another area that I'm very excited about, not so much from the capital appreciation perspective, but more around blockchain technologies having a new infrastructure, really the first new infrastructure since the internet, mobile, and now blockchain, having a truly new infrastructure that can be used to reinvent the way that we do things in the real world. And it's I think we're just starting to tap into and understand the abilities of blockchain as a platform concept. And there's obviously a huge amount of energy and heat, jargon going on in there, right? But we're almost, we're past the part where Bitcoin was on the cover of Time or whatever, right? Like we're almost past the point where people start, we're almost to the part where people stop paying attention.
Yeah, 2017 was when I think like the news and the average person woke up to Bitcoin and blockchain. And a lot more exciting, real things have happened since then. But you're right. Like, I bet my parents or people, who are not that plugged in don't know and don't have that impression.
And then the third thing, if I can just say one more that I'm excited about, is I think we are finally at a time in the U.S. where our understanding of inequality and economic access has come together with energy and commitment around change. And it's not going to be comfortable, but I think that we finally have a chance to change who has access to entrepreneurship, what resources they have access to, and what does a successful entrepreneur look like? All right, what are the examples of female-led companies or Black and brown-led companies that make it all the way through to be an exemplar, where other people are like, oh, like, I didn't realize until they rang the bell in the NASDAQ that company was run by a woman or run by a Latino. And I think that's really exciting. And my firm is, we've been able to play a small role in that just by focusing on it, not making our exclusive way to pick founders, but just by being purposeful about it. We went from less than 10% overlooked founders to in the last 2 years, 70% in the portfolio.
Wow.
Yeah, just by deciding.
By trying to do it. Yeah.
Just by trying.
Making it a priority.
Yeah. Not making it our exclusive priority, just making it a priority. And I think that if we can do it with our small checkbook and with our portfolio of 36 companies, then there's a lot of potential out there.
That's cool. Yeah, I love that. And I think you're right. I hopefully, optimistically think you're right. That it's taken obviously far too long, but seems like enough people that I really, in my world, I have a small piece of the business world, but in my world, it seems like that's on people's minds a lot. And
Yep.
so that's step one. As you said,
Yeah.
maybe just putting it on the priority list at all is, as you said, it's kind of like that's what it took for you guys. And maybe that's all it really needs to take at least one meaningful big step forward. So that's really exciting. Cool. Well, there's so much else I'd love to talk about. Maybe we'll have you on again if you're interested. I feel like you have a really unique ability to take things that are like fuzzy and creative and apply like a intellectual rigor. You even said earlier, like, it's a math problem about something that wasn't really a math problem. So like that kind of thing, I think is really cool. I'd love to delve into that, but maybe we save that for next time because we talked a lot about this today and that was great. Really great having you on, man. And in the future, anytime you have something else you want to talk about, or if you want to dive more into that, you're welcome back anytime.
That's great. I really enjoyed it.
Yeah, man. Talk to you soon.
All right.
Bye. So if you enjoyed that podcast, if you like creativity and topics like that, or if you work in a creative field, you'll definitely love the IAA, the International Advertising Association. You should check them out at iaaglobal.org. The IAA is one of the oldest running since 1938 associations for creative professionals, and is currently acting as the global compass, sharing information like this, gathering cool minds like you've just seen to chat and to understand exactly what's happening today. So I encourage you to go check them out, iaaglobal.org.